Hello investors! In this video, we'll go over some basic technical analysis concepts that will hopefully make you a more profitable investor. We'll take a look at some real chart examples of how to recognize support and resistance and trending assets. Technical analysis is a way to evaluate investments and identify trading opportunities and price patterns seen on stock charts. A stock chart is a graph that shows the price of a stock over a period of time. Here's a stock chart. The horizontal axis at the bottom represents the date. The vertical axis is the price. When we zoom in, we see a series of green and red bars with different shapes. These are called candlesticks. Candlesticks are a tool for investors that can represent price movement over multiple time frames in a single price bar. Green candlesticks typically represent price action that has gone up during the period. Red candlesticks represent the downward price direction. This is the body of the candlestick, and these are the tails. Candlesticks can represent any time frame. This is a daily chart, so the candlestick represents one day of price movement. The bottom of the body is the opening price for the day at 9:30 in the morning when the market opens. The top of the body is the closing price for the day at 4 p.m. If this was a monthly chart, the bar would represent 1 month of price movement. The opening price for the bar would be on June 1st. The close of the bar would be on June 30th. If this was an hourly chart, the opening price would be at 1 p.m. The closing price of the bar would be 2 p.m. The bottom of the tail represents the lowest price of the candlestick. The top of the tail is the highest price. Red candlesticks are the opposite. The top of the body is the opening price. The bottom of the body is the price at closing. Allow me to reiterate this because it is an important part of reading stock charts. If this was a weekly chart, each candlestick would represent 1 week of price action. If it was a 4-hour chart, each candlestick would represent 4 hours of price movement. Let's take a look at an example of the formation of a candlestick through real price action. On the left is a daily chart with one candlestick representing 1 day. On the right is a 5-minute intraday chart. You're about to see how a series of 5-minute candlesticks can combine to make one daily candlestick. The market opens. Notice the overall price action for the day is up. The price closes above the opening price, creating a green candlestick. Let's take another look. The opening price for the day was $428.75. Later on, the low price for the day was $427.50. The high price was $432. The stock price eventually closed at $431. One of the most important things investors need to be able to identify on a chart is levels of support and resistance. Levels of support happen when a downtrend is expected to slow down due to a concentration of buyers. Levels of resistance happen where an uptrend is expected to slow down due to a concentration of sellers. Notice how price action reverses when it reaches a level of resistance. More investors are selling at this level than buying. This pushes down the price. Once it reaches a level of support, there are more buyers than sellers. This increases the price. Notice how the overall price action is sideways. This is called trading in a range. Here's a chart of price action in a range. Notice the price has dropped below the level of support. Once price action breaks below support, support becomes resistance. Take note of how the price was not able to get above resistance. This is because there are a fewer number of buyers at this level, so the price reversed to the downside. Let's take a look at how resistance can turn into support. Here's the level of resistance. Notice that once price action breaks above resistance, that level is now support. Watch how buyers step in and buy at the level of support. Let's take a look at trends. It is important for investors to know how to recognize trends. Recognizing trends will help investors enter and exit investments at the right time. Notice that the overall direction is up. Look where price action reverses and goes back to the upside. These are called swing lows. Swing highs are where price action reverses to the downside. Notice that each low is higher than the previous low, and each high is higher than the previous high. This is what makes an uptrend: higher highs and higher lows. If you draw a line that connects the swing highs and lows, you have what is called a trend line. Trend lines help make the uptrend obvious. Price action within the trend lines is called a channel. Most importantly, trend lines represent areas of support and resistance. Notice how price action reverses to the upside when it reaches the trend line. Let's take a look at a downtrend. Downtrends are identified by having lower lows and lower highs. When you draw the trend lines, the downtrend becomes obvious. Notice the level of resistance where price action reverses to the downside. Let's take a look at trend reversals. It is important for investors to recognize when a trend changes direction. It can offer good entry and exit points for investments. This price action is in an obvious uptrend. It is making higher lows and higher highs. Here is the trend line and support. The trend is intact until price action breaks below the trend line. Once price action breaks below the trend line and makes lower highs and lower lows, the trend has reversed. Here's price action in an obvious downtrend. Here's the trend line and resistance. Notice that price action has broken above the trend line and resistance. It is now making higher lows and higher highs. This is confirmation that price action has reversed to the upside. Let's talk about moving averages. A moving average is a technical analysis tool that smooths out price action by calculating an average price. For this example, we'll start with the 50-period moving average. The 50 moving average is identified by the white line. The average can be used for any period of time. Since this is a daily chart, the 50 moving average represents the average price over the last 50 trading days. If it was a weekly chart, it would represent the average price over the last 50 weeks. Moving averages are primarily used to identify price direction and levels of support and resistance. Notice the downward slope of the moving average. This typically means the price action is in a downtrend. Price action that is below the moving average can also mean there is a downtrend. As you can see, the moving average acted as a strong level of resistance. Here's an example of price action in an uptrend. The 50 moving average has an upward slope. Look where it acted as support along the way. Another important moving average is the 200-period moving average. It is represented by the red line. Since this is a daily chart, it is the average price for the last 200 trading days. Notice the price action is above the 50 and 200-period moving averages. This is a clear sign that the price action is in an uptrend. The 200-period moving average is acting as support. Once price action breaks below support, it is now below the 50 and 200 moving averages. This is a clear sign. Price action is in a downtrend. These are just a few examples of how technical analysis can be used to predict price action. If the information in this video is valuable, please like and subscribe to the channel for more information on investing.